It's been pretty disastrous when I've made it.
All right, so I'm recording now. Thank you everybody for joining me. Sorry for a little bit brief snafu earlier. People were hanging out in the waiting room. But I want to quickly introduce myself and hand it over to Neal, the mad scientist himself. My name is Jason Shao. I run two meetups, one in NorCal, one in SoCal. I'm primarily a developer myself, small, medium-sized, multifamilies or small lot subdivision, multiple houses, those kind of things. I also have a team that help people buy, sell, invest, manage properties as well. And without further ado, Neal, take it wherever you like. Tell us a little bit about yourselves and how you got started in real estate.
Sure. So I'm a recovering technologist. I'm from Silicon Valley. Data science is something that I absolutely adore. It's something that really gets me going. But I noticed from a young age that I was not interested in the theoretical concepts of data science. I was interested in applied data science. And what I found is, of all the things that I've done in technology, in healthcare throughout my career, application of data science to real estate is the most profitable for me and the most profitable for my investors. So at this point, my data science techniques are used primarily on commercial real estate, multifamily real estate, single family as well. $265 million portfolio, which is a combination of multifamily, student housing, self-storage, and we have an industrial project coming up this month. And we do both new construction projects and we do value add projects as well. We do them in about 10 states in the US. I live in California, but I don't invest in California. And today, actually, you're going to learn why. And what we thought today was that we do an interesting sort of hybrid. I have a presentation that I've presented before, and anybody that wants the deck for the entire deck, I'm happy to send it out. But what I wanted to do was actually to pick some of the slides in that deck and then have a conversation, because we've got a good group of people. Jason's here. Some of you guys, if you want to unmute your mics and Jason's okay with that, we can have a more interactive conversation because it's a smaller group than what I'm used to. So on Saturdays, I present to a group of exactly 500 people because that's how big our Zoom license is. And so it's really hard to have a one-on-one conversation with 500 people, but this is a smaller group. So I thought that it might be actually good to make it more interactive. So I've been doing presentations on COVID. If you came in late, we do about a podcast every day with different podcasters. And then on Saturday, we do a webinar. Tuesday, last night, we did a webinar with about 400 people on it. And a lot of it is really about the impact of coronavirus in different ways, right? So we look at single family, multifamily, loans, equity, what's happening to the debt markets, what do we expect to see in terms of pricing on both the single family and multifamily side. So it's a very wide-ranging conversations. Because we are data geeks, everything that we do has to have numbers attached to it. So you'll see lots and lots of interesting slides today that are driving our thought process and our mindset. And so I thought that it might be great to have a freewheeling conversation about that.
Okay, yeah, that's great. And so for folks, if you have questions, feel free to pop them in the chat box or raise your hand and I'll unmute you, basically, kind of thing. I don't want to unmute 30 people at the same time. And so I guess, what are some indicators, or main indicators that you've been tracking, Neal?
Yeah, so let me share my screen so I can bring those up on the screen. That's the first question that I get today is, okay, so we did this whole COVID thing and we did a shutdown. What happens now, right? So where are we today? And so the first thing that we've been doing is that, firstly, we've been telling people, because there's this question on whether we needed to do a shutdown or not, right? So staying away from politics, there's a group that feels that doing the shutdown was not necessary, and then there's a group that feels that doing the shutdowns was absolutely necessary. So given that I'm not involved in the politics of it, here's what I found the data supported. So before March 22nd, and the US started to shut down on March 22nd, if you look at this slide, the United States had the fastest growth rate in new infections in the industrialized world. We were even worse than Italy, and we used Italy as the bad example in this world, right? So look at this. This is our daily growth rate before shutdown. And I can tell you that this daily growth rate, if you exponentially grow it to April 30th, which is today, right? So we started shutting down on March 22nd. 38 days later, if you grow the same rate without shutdowns in the US, the kind of tragedy that we would have created economically and from a healthcare perspective would have actually been worse than the tragedy that we have created by shutting down. So most people don't know this, but taking this exponential for the next 38 days would have infected 2/3 of the United States, completely destroyed our healthcare system, because our healthcare system is a paid healthcare system. It cannot function. And we would have definitely needed over 1 million ventilators in the US. So it would have been not just a massive tragedy from the perspective of, human life, but it would have been an even worse tragedy from the perspective of the economic devastation. Really, our country would have been destroyed. That's what the data says. And I don't care whether it's a Republican saying that or a Democrat saying that. That's what the data says, right? And notice what happens the moment we went into shutdown. So look at the difference between this slide. Look at the green line. Look at where Italy is going. And then look at what happened to us now. That's us. Clearly, the mathematics shows that the shutdowns have a very drastic effect, and those people that say shutdowns don't work are not data-driven. That's all I can say, is they're not data-driven, or they're selectively picking data from certain areas and saying, well, what about this state, or what about that state? Well, the states that didn't shut down at the end were lucky, in that the rest of the United States had shut down. There weren't people coming into their state. The airline travel was shut down, so the R0 dropped. So the infection rate dropped. Your ability to catch it from other people dropped. There were no conventions, no movie theaters. So those people, using those few states as examples, I think is a very poor use of data. But it's very clear that the moment we shut down, our infection rate dropped at the same rate as Italy. In fact, this rate, we extrapolated it for the UK, for Spain, Germany. We did it for a lot of different states, and we actually put that data. Take a look at this. There's a website that we created called coronavirusrealestate.com. And on this website, each day in the morning, and it's already been updated for the day today, we put in an Excel spreadsheet. And what we're doing is we're tracking infection rates for other countries, because using the US as an example by itself is a bad idea, because we've got partisan polarization that affects everything that's happening. So it really helps to look at what other countries are doing. So here you're showing daily growth rate for the United States, Spain, Philippines, India, United Kingdoms, and a number of other countries to the right. Some of them we've stopped tracking because they've dropped below 1%. So we've stopped tracking South Korea and Iran and Italy, because at this point they've dropped to a very low level of infection. But each day we're looking at how we're doing in the US. And bottom line is, the data shows that if we didn't do the shutdowns, the end result of that by the end of April, which is today, would have been absolutely catastrophic compared to what has already happened, which is also catastrophic, but a lot less catastrophic than the alternative. That's what the data told us. So, hopefully we don't get into the politics of what that means. Sorry,
a quick sidebar. Can we take a look at Sweden?
So we looked at Sweden, and what we found was that Sweden's not testing enough for those numbers to make sense. And what's happening is the rest of the world is on its way down. So when you're looking at every other economy in Europe, when we're looking at the United States, everyone is on their way down the curve. But Sweden at this point is actually on their way up. So for us—
Sorry, to fill everybody in, I mean, Sweden has a very different approach. Do you care to share, explain a little bit?
So in Sweden, you go to Sweden today, you can walk into a restaurant, right? There's no social distancing. A restaurant in Sweden serves you the same way today as they did, in February. So you sit across a table. They've got certain measures in place, like schools are closed and those sorts of things. But they're taking a very unique approach from what everyone else has done, in that they really didn't shut their economy down. Movie theaters are open in Sweden as well, even though there's not a lot of movie theaters playing, and they're mostly empty, but they're open. And so Sweden took this approach of, we are going to try and keep the R0. R0 is the number of people that each person infects. We're going to keep it right below 1% by manipulating the shutdown as we go. And as we see it going up above 1%, we'll shut it down. We're going to address hotspots. It's a very evolved approach. It's a very advanced approach. It's a very risky approach. It's still not clear whether Sweden has won or lost. But here's what is known today. Sweden has 10 times as many deaths as any other Nordic country. Finland, Norway. What's the other country? I'm forgetting one. So there's four Norwegian countries. Sweden's one of those four. The other three have 1/10 the deaths or less than Sweden. And all of the remaining Norwegian countries at this point in time have shown significant declines in their case rates, where Sweden, depending upon which day you look at, is either flat or going up. And so the Swedish experiment is very interesting in that it tells us what worked or not. They are doing experiments with movie theaters. They're doing experiments with restaurants. And as they experiment, we're going to take that data and use it in our countries. But I would not recommend that a country like the United States take an experiment on like Sweden. I think that what they're doing is a large-scale social experiment with millions of lives at risk. And I'd much rather just study them and take the data from there and use it. That's my feedback.
Do you have any data on Sweden that we could take a quick?
I don't have it in a way that I can present to you, but I encourage you to look at it because it's very interesting. The Swedish data is very interesting, but it appears that they're not doing enough testing yet for us to use that data, and that's changing, and they're doing more testing like everybody else. But from what we are seeing, there is no way to say that Sweden is an example of how you can not shut down your country and still get through this. That hypothesis cannot be supported at this point, and probably won't be supported for the next month or two until Sweden significantly increases its testing capability. And once again, this is not a case of whether student did the right thing or not. This is a case of different countries trying different things and then us learning from them. But if I had to choose an option today, knowing what I know now, I would choose shutdown over the Sweden method, because the data clearly shows that the shutdown method is very aggressive. I mean, just look at the difference between the green line on this slide and the green line on this slide. And really, they're just 20 days apart. So you can see that shutdowns are highly efficient. They move the 8-ball very, very quickly. And so it makes sense to do that. But the next question that I've been getting at all of these webinars is, okay, fine. So we shut down, and now what? What happens now? Well, the best thing that we can do at this point, Jason, is shouldn't we be looking at other countries that have come out of the phase that we are in right now, right? We're looking to come out of shutdown in the next couple of weeks. So I'm tracking data for China, right? So the first thing is, I look at their retail sales, right? So how are they doing after they came out of shutdown, and are they going back to where they were? And so this is all data after the year-over-year change. So you're looking at the beginning of the year, and then you're looking at now, let's say a week ago, that we updated this like 3 days ago, and so you're seeing which sectors of the economy are down. And the problem is that even though China at this point has pretty much 0 cases, I think they had like 8 cases yesterday for a country of 1.2 billion, and nobody's at this point better prepared to test than China is. They've done a phenomenal job at this point. Let's not talk about what happened 3 months ago, but today they're very well prepared for this. Their population is very well trained, but the numbers are in front of you. China at this point, having come out of this, is in the greatest recession they've had since the Chinese economy opened in 1979. These numbers are catastrophic, right? They're a typical recession. These numbers go down 1%, 2%, 3%, 4%, 5%. But when you're looking at these numbers, they're down a massive percentage, right? And the only bright spot is this one here, which makes me happy to see that their retail sales, at least the online component, is only down 3%. So the Chinese are spending money again. That's good. But here, take a look at this. Retail sales of consumer goods, which is a much larger bucket than the online retail sales, they're still spending 20% less than before. Nobody could have possibly imagined a scenario other than coronavirus where the Chinese economy would stop spending 20% of the money that it's spending. And so this is what worries us. This is an economy that at this point is in recovery and is still basically running 20% below. And we think that this actually represents what the rest of the world will do. And if we look at other statistics, so here's how much coal China is using, right? So this is how much coal China is using after it's recovered, and you can see that they're not using enough coal. They're using only 80%. Their automobile sales have not recovered fully. Their property transactions have not recovered fully. So what we're seeing is this bizarre world where after recovery, the world economy is 80% of what it is. And if we don't find a way to fix that, we go into an extraordinary recession that no one has ever seen before. Nothing like this has ever been seen before. Here, this is traffic. This is actually very interesting. So when we're tracking traffic for major, these are like the superstar cities, right? Beijing, China, Guangzhou, Shenzhen. We're tracking their traffic. This is an actual picture of traffic in China after China reopened. So you can see there's a lot of traffic. The problem is that we are seeing traffic returning to 90% of normal levels on weekdays, but on weekends, traffic is still at 10% to 20% of normal levels, which shows that psychologically the Chinese consumer has been hit very, very hard and refuses to do any kind of free time travel or any kind of travel that is totally up to them. Obviously, going to work is not up to them. They need to work. And that is hugely worrying us. I have a different graph, which is not here, that shows you, the Monday through Friday numbers on that graph, and they're pretty much 90% of where they were. And on Saturday and Sunday, there's almost no traffic. So it feels like a city in quarantine. And I think the governments of the world have to fight with this challenge that the consumer still feels like they're in a quarantine on Saturday and Sunday. Because if we don't fix that, the world economy shrinks by 20%. And I mean, 20%, for most people that understand this, 2 to 3% is a normal recession, a world recession. 20% is like 1929. That's what the numbers look like right now. And I hate to be the bearer of bad news, but the purpose of this webinar was not to offer you good news. The purpose of the webinar was to show you what is happening to countries that are coming out. Now, we're seeing the same sort of trends in Singapore. We're seeing the same sort of trends in South Korea. These are economies that are ahead of us. And so it's extremely worrying to see the sort of challenges that these sorts of economies are developing. So here, for example, on this particular slide, you see GDP declines in past crashes. So in 2000 and in the 2000 recession, GDP only went down 0.3%, our great domestic product. In the Great Recession, it went down 5%. In the Great Depression, it went down 26%. Right now, if we don't do something, and I don't know what that something is, by the way, I think we're looking at a bar much larger than the Great Recession. It could be 2 or 3 or 4 times this size. So that's what we are potentially looking at. Now, initially there was this feeling that, oh, but it's only 3 or 4 months. Compare that to the Great Depression, where you were, the market, took 34 months to bottom, and here, it took 43 months to bottom. And in COVID, it's only take a month to bottom, so it's going to go down sharp and then come back up sharp. So our up leg is only going to be 1 month or 2 months. We don't see any evidence of that either. It looks like the down leg was 1 month, but the up leg might still resemble something like the Great Depression or the Great Recession. It might take us 30 to 40 months to get back up to where we were in February. That's what the data seems to point to at this point, unfortunately. And yep, so there we go. And keep in mind that it takes much longer to recover from deeper recessions. So the Great Depression of 1929, it took 25 years for the market to recover to where it was. Whereas the Great Recession, it took about 4 years. So depending upon where you think we are, market recovery is going to take a very substantial amount of time. Now, obviously, we put a huge amount of money into this, both from Congress's perspective and from the Fed's perspective. But when we look at the damage to the world economy, I think we need to inject somewhere in the 12 to 14 trillion dollars. I mean, the world economy is roughly $80 trillion, and so which essentially $80 trillion a year, which means that it's about $6 trillion a month. And we're losing about 30% of that. So we're losing $2 trillion a month. And so we need to put in, $2 to $3 trillion a month for April, for May, for June, at the very minimum. I don't think that we're injecting $6 trillion in yet, so that's a problem. And also, I think that because China shut down sooner, we need to count an extra trillion or two for China's decline in Jan, Feb, and March as well. So I think we need to inject at least $8 or $9 trillion just to start undoing some of the damages. And you can't undo all the damage because there's restaurants that will never reopen. There's mall operators that will never reopen. There's retail operators that will never reopen. The fate of the airlines is unknown. The fate of cruise ships is unknown. So there's just an incredibly large number of unknowns in the marketplace. Except I can tell you that what is known now, and maybe we can switch to that, is that rents are much stickier than all of us thought. So a month, I have 2,000 units, so obviously I was terrified with what would happen to rents. And so a month ago on a webinar, somebody asked me, what percentage of rents do you expect to collect in April? And I said, it's going to be between 50 and 70%. That's my belief of the rents that I can collect, given that 26 million Americans are out of work. Well, nationwide, apartments have collected over 90% of the rents that they collected in the month before. So it's been well over 90%. Class A apartments have collected like 96%. Class C apartments have collected 90%. Those are not good numbers. Obviously, in a normal time, you would want to collect a lot more than 90%. But those numbers are good enough so that pretty much every apartment in the US can pay their mortgage, which is all I care about right now. I'm right now in protection of capital mode. I'm not looking to make money for my investors. My job is to protect their capital. And luckily I'm getting enough rent so I can protect their capital in the month of April. And I can pay my mortgage. And remember, I have reserves as well. Typically apartment complexes have 3 to 6 months of reserves. Some of my properties have 15 months of reserves. And so the good news is that real estate, particularly single family and also multifamily, has shown that it's actually much more sticky than most people imagine. And by the way, those of you that are typing in questions, I'm going to start taking those in a minute. But I wanted to give you this feedback that so far, the story on real estate is very uneven, where we're seeing some portions of real estate do really well, single family, multifamily being on one side, industrial doing even better. Why? Because, obviously e-commerce is up like crazy, so industrial is the only positive part of real estate. Everything else has definitely declined to varying levels. But then there are other sectors of real estate that are massively hit, like absolutely massively. So let's take a look at those, but let's get to some of the questions first. So I'm gonna show you the different sectors and how they're hit. Let's see, so I can skip there. So this slide is very interesting because it shows the biggest losers and the least affected. So, take a gander at this slide while I look at some of your questions. So Jatinder said 93% in collection in April per my PM who manages 800 units. Jatinder, I think that's pretty common. We're seeing 90 to 94% collections, which everyone, I have to say, a month ago, if you'd given me that number, I would have taken it in a heartbeat. I'm really delighted to see those kinds of numbers, right? And then Paul says, April's only the first month. We have to wait until the following months to see the effect. The answer is, you're right, Paul. You're right. But there's factors to consider. The month of April was a true unknown. Now we've set a benchmark that people are paying rents. Also, the month of May includes good news. In the month of May, state after state is going to, quote unquote, go back to work. So mentally, people will be in a better place. But the month of April was a shutdown of not just the United States, but the world. So from a pure perspective of consumer confidence, I think it was the bottom, right? Now consumer confidence goes up. Now, of course, if we reopen and very quickly we have to shut down again, we might see a lower bottom in consumer confidence in the future. But I do not believe that. I believe that between testing, between antibody testing, and us beginning to understand what we need to do, I think we're going to be clever about it. And while shutdowns will occur in the future, they are likely to be localized. So you might see a city shutdown, you might see a portion of a city shutdown. That's extremely likely to happen. But I don't see entire countries going into a shutdown in the future, because we've learned a lot. We've made a lot of progress. There's been a lot of technological progress. Testing in the US is up. We went from 50,000 tests a day to 100,000 to 200,000. And now it looks like by next week, we're going to be at 350,000 tests a week. And all of that helps because it's about identifying early. How do you get the R naught down from 2.7 to below 1? Remember, no one is trying to get the R naught down to 0. You don't need to get it down to 0. If you can keep the R0 below 1, what that means is one person is infecting less than one other person. If you can keep it there, then there's some collateral damage. There are going to be thousands of people that will die each month, but well, more than that die from the flu each month in the United States. We don't shut the United States down for the flu. Here we had no choice, right? I showed you the data. We had no choice to shut it down. So Paul, my feedback to you is the month of April only had bad news. The month of May has bad news and good news. More people get the checks that are coming from Treasury in May than they do in April. Some parts of the US are reopening, so there's that mental benefit. Some people get reemployed because some states are opening fairly quickly. So I think that towards the end of the month, if you have your job in May and you had the money to pay, then there's a higher chance that you would pay because you've got your job back at this point in time. So even if you get your job back by May 20th or May 25th, that's going to have a positive impact on our collections. So people ask me, how much do you think people will pay in May? My feeling is it's going to be about the same as April, or maybe a little bit lower, tiny bit lower. And if it's a little bit lower, I think that's a victory. I think that's a win. Let's see. All right. So I'll take this another one. What do you think will happen to rental prices during a depression in metro markets? So in a depression, if you're looking at a 1929 type depression, I think all rents fall. But rents have proven to be much more inflexible than asset prices. So one of the charts that I love showing people, I'm going to go to my research folder here so I can find it for you guys. One of my favorite charts is that we all know that the prices of home prices in the US in the 2008 recession fell by a huge number, right? But most people don't know how much rents fell in 2008. And obviously 2008, that recession was really bad for housing. There were millions of homes on the market, and housing was generally illiquid. In that scenario where housing was illiquid, it's amazing to see what was the historical rent change year over year. Rents were only negative in that catastrophic recession, which was really a depression for real estate. It wasn't a depression for everything, but it was a depression for the real estate market. Look at this. Rents only fell 1 year. And notice that even though they fell here, and they fell the most, I think, for Class B, down about 8%. Class A was down about 6%. Class C was down about 4%. So on average, maybe they fell 5 or 6%, somewhere in that range. Only 1 year. And then you notice what happened the following year. So even though Class A rents fell 8% here, they were up, look at this, they were up 13% within 2 years. So Class A actually more than made up for that decline. So if you average out 2009, 10, 11, and 12, rents did really well. Rents did really, really well. We got more than our usual 2.5% or 3% that we look for. So there was nothing really wrong with it if you look at it as an aggregate 4-year time frame, and this should give you some confidence, right? So I'm trying to answer Keith's question. So Keith, you're asking this question about rental prices. Well, this was a real depression for real estate. And over a 3 to 4 year time frame, we did really well with rents. So I don't expect rents to go crazy. Now, having said that, prices are a different thing. You didn't ask me about prices, you asked me about rents. I think home prices in a depression scenario dropped significantly. I think apartment prices dropped significantly. So it all really comes to your ability to hold the asset through the crisis, and hopefully you're able to hold through this dip and then enjoy this spike that comes after.
Hey, Neal, I have 2 questions. Just kind of gut reaction looking at this chart, and there might be perfectly fine reasons for it. Why is Class B, the bottom, more severe than Class A and Class B? And I also noticed that maybe I'm reading too much into it, but the Class A, Class B, Class C, the bottom kind of bottom out at different times, so to speak. Do you have a gander on what the underlying reason might be for that?
Yeah, I think that the biggest reason, so Class B declined a lot because it was those people, a lot of those people moved over to Class C, which prevented, so the B people tend to move over to C easily, right? The A people have a lot of money, they have a lot of prestige, they don't give up their apartment easily because they've got $10,000, $20,000 in the bank. So there's a little bit of a resistance from the Class A people to kind of move out. And so you see these different sort of timings. But in the end, this is very homogeneous. I mean, it's within 2%. So everyone reacted more or less the same way.
Right.
But beyond that time, you notice that Class A recovered very quickly, right? So this is rent change. And you notice vacancy, right? So a lot of people are like, how will Class A, Class B, and Class C multifamily do? Well, in 2008, and a lot of people say the exact opposite of this, which pisses me off because the data is really there. It's Class C that saw the biggest vacancy, because those people have $400 in the bank. When they lost their job in 2008, they went and lived with mom and dad in their garage. They lived in their car. They lived in their mobile home park. They lived on the street. And so you saw this big, spike. There really was no occupancy decline for Class A and B, because, I mean, in 2003, you're at 6%, 2009, you're at 6%, and then occupancy declined, a vacancy declined, so occupancy kept growing, right? And there was a slight pickup of vacancy here in Class B and Class A here, because we delivered 1 million apartments in the last 3 years. So we delivered a lot of new inventory. So there's a slight uptick here, but these numbers are all great. But it was Class C that took the longest to recover, and we think that this time, again, it's going to be Class C that will take the longest to recover, because this recession is a blue-collar recession, right? How many white-collar workers are serving tables? How many white-collar workers are working at airports? And how many white-collar workers are serving in airlines? So the people that are getting hit disproportionately are the poorer people this time. In 2008, a lot of rich people got hit because they bought all these homes and their value declined by 50 or 60%. Here, the poor people are getting hit first, right? So we think we would see an increase in vacancy on the Class C side, and it would take a substantial amount of time for that vacancy to come down to match Class A and Class B. And we've already seen that in April. Class A properties did phenomenally well. We have a Class B property, Park Canyon, in Dalton, Georgia. It collected 100% of its rents. But our worst property was a Class C property, which so far has only collected 82, 83%, or somewhere in that 84% range in rent. So best Class B, 100%. Worst Class C, 84. That's a huge difference, don't you think? So just looking at some of the other questions, and keep firing away, by the way. So do you track supply versus demand in units? How is that looking versus today? So, that's a very interesting question. A lot of people say, well, we have demand and we have, we have a supply gap, blah, 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 because of household formation. I just want to say to you, Gene, all of those numbers no longer matter, because one of the secrets of real estate is people like me and other people that say there's a lot of demand. Well, that demand is based on household formation, okay? If magically one day household formation falls off a cliff, and it just did, then that demand goes down. Supply remains the same, demand goes down. So in January, we had a 4 or 5 million person supply-demand gap where, demand was high and supply was low. So that gap was there, it was real, it was affecting, cap rates, it was affecting rents. Today, magically, that demand has dropped, not just to the point of supply, but it's actually dropping below that number. And so today we can't say that we have higher demand in the US than we have supply. That is true for lower level workforce single family. That segment continues to have more demand than supply. But how many builders in the US do you know that are actually building workforce homes? Last year, I think 7% of all housing built in the US was workforce. 93% was, granite countertops, steel appliances sort of stuff. So bottom line is nobody's really building in that segment. That's why the demand there is very high. But those of you that are thinking that we have this huge supply-demand gap that's gonna protect you, I think that is a very unreasonable methodology. I think that demand just fell off a cliff, and that cliff was millions and millions of units. So Neal, what's your outlook on office buildings and retail centers that are not malls? So I think retail is toast. That's my honest answer. I think they're about to go through a massive depression. From what we've seen in April, like half of the retail centers, the tenants didn't pay anything. And those numbers varied so much that there were some retail centers where 20% of the people paid, which was, staggering, because the problem is that those retail centers, the person that was the dentist, or the person that was cutting hair, or the nail salon, those people lost 100% of their revenue. Whereas in multifamily, we lost, depending upon the property, we lost between 20% and 0% of our revenue. So the loss to a running business of 100% of their revenue for, let's say, 60 days is so catastrophic that many of those businesses are simply destabilized. And because those businesses are destabilized, the retail center marketplace is today completely unstable. I've listened to Marcus and Millichap. I've listened to Berkadia. That market has been destabilized, and so it's now where we were in this third quarter of 2008 with the real estate market. That's what the retail market looks like. It's completely illiquid. Nobody wants to buy anything. Nobody wants to pay rent. You've got like crazy conversations going on about, potentially prices falling 30, 40, 50%. God only knows how much they'll fall. But that sector, all we can say is nobody knows what the heck is going to happen. Now, office buildings are not in the same place. There's a lot of reasons for that. Number one, a typical office tenant is better capitalized. So an office tenant is often not a running business. They have 6 months, 9 months, 12 months worth of, operating expenses in the bank. Whereas a nail salon, really, nail salon is a business where they're, instead of you working for other people, you're working for yourself, but you're still an employee, right? It's not like you have 6 months or 9 months worth of money in the bank. And so a lot of these retail centers have those kinds of tenants, whereas the office sector received most of their tenants paid rent in April. So April itself was very strong for the office sector. And then you've got some tenants that are too well capitalized for them to break their lease. They don't want the dings. They don't want to end up in court. So it's going to take a very long time before you start seeing problems in the office sector, at least 3 to 6 months. Will prices decline there? Yes. Do I see like a crazy recession coming? No. The X factor, of course, in the office sector is what is the impact of the Zoom effect, right? So we're all talking about the Zoom effect where companies are getting used to working over Zoom as opposed to working in an office. How long-term is that effect? I think that's a true X factor. Nobody knows. I have no idea. So I'm going to say that if the Zoom effect is significant, then office could go into a depression mode as well. But I don't, at the current point, there doesn't seem to be much indication of that. And certainly from a rent payment perspective, I'm not seeing a problem with offices. So that was Larry's question. I think I've answered Paul's as well, and Keith's. Let's see. So Jatinder has an interesting question. So interesting to see what May is given our testing capacity and mismanagement of coordination across different government agencies. Isn't a second wave more likely? Yes, the data, and again, this is not about, whether you're a Republican or a Democrat, so please don't take my answer in a way that is partisan. But from what I am seeing, and I'm going to try to find this website that I take data from, Our World in Data. So if you go to the website called Our World in Data, they've got graphs, and these graphs are going to show you. There's 26 of these very powerful graphs. Oops, I'm in the wrong place. And I'm going to go to this page and then go to COVID pandemic slides. These slides, what they show you is unless somebody is manipulating this data, we have the worst hit in the world amongst the industrial nations. I mean, the first slide itself is damning, right? So mismanagement, yes, at a colossal scale. In my mind, a second wave is much more likely in the United States than in any other industrialized country in the world because we're still fighting the data. And because we're fighting the data, you look how lonely we look. The red line looks at the top of this graph. Look how lonely we are. And you notice that Europe has shown a lot of solidarity, where Italy and the United Kingdom and a number of other countries are in that cluster. And then you have really well-managed countries like Germany and South Korea. Brazil is early days, so we can't really talk about them. But slide after slide of this data, no matter how you slice it, shows that we have massively mismanaged this crisis. So are we at a risk of a second wave? Yes, I think we're at an extremely high risk. Let's see, what else? Okay, all right, so let's go back to this slide that's on the screen. I wanted to show this slide to you and just talk through it. So the sectors that seem to be taking the biggest hit are, are the senior housing sector. Why? Well, the example I've been giving is, so your mom or your grandma is in a senior housing facility, and you have the ability to, you have an extra room in your house. Would you not go and get your grandma out of that senior housing facility and stick her in that room so that she doesn't have to live in an area where the virus is circulating through the hallways? The people that have that ability are pulling their grandmas and grandpas out of those facilities. And so you see that the stock, these are commercial real estate REITs, right? So we're looking at declines in stock prices. So the hardest hit has been senior housing, followed by skilled nursing, which is kind of similar. And then, of course, you see hotels. Gaming is also hotels, so basically Las Vegas hotels. So you see these hit pretty hard. Student housing was hit pretty hard initially, and now is beginning to recover as we learned something interesting. So this is actually very interesting, and I've learned this by going to student housing webinars. The students are choosing to stay in colleges, in college dorms that are allowing them to stay and take their classes on Zoom instead of going back home. My son came home, but most kids did not come home. So any place that is allowing kids to stay in the dorm are very highly populated, which has been explained as the students think that the dorm is their home. They don't think that their parents' home is their home. And so that was a unusual sort of thing that I don't think anybody was predicting a month or 2 months ago, but we've seen pretty high occupancy in dorms. Obviously, some universities have closed their dorms and forced the kids out, but I think that that's going to change. And when that happens, the kids are going to come back in. Because I think that even if they are in their rooms and they're not physically going to class, they identify with that as their home. And so I think that the student housing sector will recover much faster than most people thought. When it was taken, malls were at 29. Now they're at minus 39 or 40 as people start to realize that they're going to get hit. I'm not so sure why manufactured homes are hit so hard. The only explanation I've seen is that mobile home parks, a lot of those tenants are the ones that have been laid off. They're the people that are serving in restaurants. They're the people that are cleaning the movie theaters. And so that sort of made sense to me. So maybe that's why it's hit. Office, as you see, not as hard hit. Apartments, minus 23%, and this number is now going down to like minus 15 because of the overperformance of apartments relative to other asset classes in April. So we did much better than we thought we would, and so the risks that are going down. Single-family rentals are doing really well, really well, and makes sense. Why? Because someone who can afford to pay up for a single-family rental has more money in the bank. And some of those people are white collar, not blue collar. So they're not serving in restaurants. So they still have their job and their company is still paying for them, right? So we're not seeing much impact there. And then the area that's done really well is self-storage. So self-storage also was a very overperforming asset class in the 2008 recession. Medical offices have done well because demand for medical offices is going to go through the roof. Cell towers and data centers are very small parts of real estate. Notice that there is one big asset class missing from this chart, and that's industrial. So I wanted to let you know that industrial is right here, right next to self-storage. So not hurt at all. Why? Because of the Amazon effect. Amazon just hired a quarter million people. Millions of new customers have signed on to Prime. Millions of new customers have signed on to Instacart. So all of a sudden, people have become more comfortable ordering in and those sorts of things. And all of that is a boon for industrial, for warehouses, for logistics, for supply. Also, the United States is realizing that we were a just-in-time country or JIT country where we had 4 days of everything. We had 4 days of toilet paper and we had 4 days of hand sanitizer. And obviously, that was a mistake. And when you fix that and turn into something more reasonable, like having 2 weeks of supply, well, doesn't that mean that you need twice or 3 times as many warehouses in the United States? Don't you need logistics that go with that? So I think industrial is the big winner from COVID. Not self-storage, but industrial. That's the big winner.
And, so I know we're at 150, 151 now. I want to make sure you get through the material that you want to, and then if we have time, I don't know if you have a hard stop at 2 or not. but and circle back for the questions.
Well, I honestly, the funny thing is the first part of my deck is more or less things that people know now. So I think that this deck is one that all of the slides become outdated in a week. So I think these are all things that you guys know. So in my mind, I think I'm done with most of it. I did want to put up some food for thought for those of you that like playing the stock market, trading the stock market. There's some interesting stocks that you should look at that I think have opportunity in two different ways. These are stocks that are doing poorly. So I think there's some deals in here. My favorite is this one, Royal Caribbean International. What's also not on this slide is Boeing. I don't know how we forgot Boeing, but Boeing stock is down 75, 80%. So there's some interesting deals here depending upon what you believe in. I'm not a stock advisor, so obviously just look at this so that it's a basis for your own research. But I think that there's some interesting deals in here, like Southwest is a good deal in my opinion for what its stock price is. And then you've got some stocks that I think stand to benefit from COVID, right? So we've seen the gaming industry have record server load. Activision, Zynga, Electronic Arts, all complaining about massive loads on their servers. We've seen grocery stores do really well. We've seen stores like Costco do well. Gun stocks are going through the roof, right? So gun stocks are actually a great buy at this point in time. And maybe, especially if the process continues, then you've got stocks that are in the vaccine area, like Gilead, that make a lot of sense to do. One group that is not in here that I want to give as a tip to you guys is this group. So companies that do thermal imaging, and they make thermal imaging cameras. So the thermography area is going to see the biggest boost, just like in 9/11. After 9/11, what was the #1 industry in the world to be in? It was those airport scanners that we are now used to going through, right? So people bought like tens of thousands of airport scanners. Well, here it's not just airports, because movie theaters are saying, we're going to put a scanner, and if you come in and we see a person that's red, we're going to ask you to leave immediately, right? Large restaurants are saying that they're going to do that, like Cheesecake Factory is saying we're going to do that. Stadiums are going to do that. Conference centers are going to do that. So we're going to need 10x or 50x the thermal imaging machines that exist in the world. So companies like FLIR, this is the name of a company, FLIR. These are companies that are going to do really, really well. They're the big gainers because they build thermal imaging equipment, both handheld and screen-mounted equipment that pretty much every airport and pretty much every railway station in the world is going to be begging for, and there are not going to be enough of these.
Yeah, I mean, in Asia during SARS, like, I mean, I don't remember exactly the time lag, but that was every airport, every public place had those. So, and then I'll comment real quick, not stock advice, but Shopify. So we're building a food hall. A lot of our vendors, they're having to pivot, so they've been doing deliveries and pickup orders, and a lot of them were using Shopify to set up their online stores, basically. So I think the key takeaway for everybody is to observe and study and look at what's happening to the supply demand, whether it's different factors, just life all around you kind of thing, to identify the opportunities. I guess I'll put it that way.
There's a remarkable amount of opportunity. I mean, I just keep buying Boeing stock and then selling it a few days later. Then I keep buying Boeing stock and I keep selling it a few days later, and I make $15 deltas. I bought it at 146, sold it at 156, bought it again at 125, sold it at 145, because it's a volatile stock. Nobody knows what's going to happen. But in my mind, Boeing has turned down offers from the US government for assistance, for financial assistance, because they don't want to be handicapped. So the worst case scenario for Boeing is it takes that money. But the world is not going to, the #1 aircraft manufacturer in the world is not going to go out of business, right? They simply can't, because they are a defense contractor. So the government has to support them no matter what. So I think there's a lot of opportunity. A lot of people freeze up. I'm telling you guys, this is not the time to freeze up. This is the time to look at investing. Now, obviously the deals are not here yet because the economy is closed, but you're going to start seeing deals in the retail sector by July. You're going to start seeing deals in single family, multifamily by a quarter after that. I think you need to act.
Two questions. I talk about the Fed and talk about oil. Those are pretty big topics.
Well, I think that one key thing I wanted to give you was in 2008, the price of oil went to $147 a barrel, and was one of the reasons why we had that recession. Oil was one of the big factors that people don't know about. And you know why that happened? Because we had 3 million barrels less than we consumed. So our supply was 3 million barrels less than our demand. Oil is an extremely inflexible area. We have to have oil, right? You saw that picture of the Chinese going to work, a week ago. They're all driving in those cars, right? And then China has some electric cars, but the vast majority are gas cars. So in the short run, oil is the demand for oil has to come back if the world reopens. And even if the world reopens and some portion of it gets shut down, and and then it reopens again, and we kind of play this game, right? I call this game the dance. Where the world is finishing the phase known as the hammer. And now we're going into a very delicate phase called the dance, where the virus is here, we're here, we dance with the virus together for a number of months. But even in the worst case scenario, the world still gets to about 85% to 90% of its oil demand. Today, oil has crashed to a ridiculously low level. And that makes no sense whatsoever. Oil prices make no sense, but they make sense because the world is shut down. But 2 months from now, if the vast majority of the industrial world is back up, and remember, not every country is going to be back up, but the vast majority of oil is the industrialized world, which, China, Europe, and the US are going to be open a month and a half from now. So that inflexible oil demand is going to go up. So I think that these low oil prices are temporary. You are going to see a massive number of bankruptcies in the shale market. But let's say you're not invested in the shale market, you don't have to worry about oil, because what happens is oil is very valuable. So those shale stations are very valuable. So what will happen is a company goes bankrupt, somebody else buys them, right? So Chevron and Exxon will jump in and buy those companies. The oil will continue to flow. The US shale revolution will continue, but owners will change hands. So I think that oil will come back up. I think that if the world recovers well, then a year from today, oil demand is more or less going to be in that 90 to 100 million barrel point that it was. So I think that it's a short-term debacle that should be more or less over by the end of this year.
How do you feel about what the Fed is doing?
I think the Fed's doing what they're supposed to be doing. I just don't think that they're able to do enough. I think that the Fed was the first to recognize this well before Congress. Do you remember that one day where they cut interest rates to zero without notice? And they did it on a Sunday, so it wasn't a scheduled meeting. And so in my mind, hats off to the Fed. I think they get 100 out of 100. Congress gets maybe 50 out of 100. The administration gets 10 out of 100 in my book. I think Congress has also been fairly aggressive and quick about what it needed to do. Given the rate of partisanship in our Congress and the fractured country, I think we did well. But the Fed has done a phenomenal job. The Fed is buying everything. I mean, they're buying all kinds of assets. So if it doesn't crash the world economy, we will come out of this praising the Fed 5 years from now as being the one that protected us.
Doesn't that create some kind of unintended consequences as well, though? Because if they're just buying everything, what happens to John bonds or, I guess, are they really just buying everything, or I guess, yeah. So
my favorite example to that is, the land of the rising debt is Japan. We are at 104 or 105% of GDP to debt. They are at 250%. They've been doing what we are talking about here that the Fed is doing. They've been doing that since 1989, and they've been doing it very aggressively in the last 8 years. Hasn't crashed their economy, right? We're still by far the best looking pig in the pigsty. By far the best looking pig in the pigsty. We look ugly, but everybody else looks a lot uglier, which is why our status as the reserve currency of the world is safe. And as long as we're the reserve currency of the world, I think what the Fed is doing is yes, it has long-term unintended consequences, but I don't think it has short-term unintended consequences. I think our economy keeps moving forward.
Yeah, I mean, I think I would be fine too, because I mean, everybody talks about the whole worry about inflation and what all the QE last time around. I mean, obviously, every cycle is a little bit different, and kind of to your point too, you know, in relations to the debt to GDP, and it's a little bit higher than before, but looking historically, it wasn't that high or as high as some of the other countries, like Japan, like you mentioned. So
Right now, nobody can be blamed for it. There's nobody that's saying, oh my God, stop spending money because your debt to GDP is so high. We are in a black swan event. People think differently in a black swan event. So everyone's spending money. The rest of the world is spending money. Everyone's doing quantitative easing. I just don't think at this point we're going to take the kind of criticism that we took when we did all this stuff in 2008 and 2009, because back then there were people saying, don't do it. Today, people are like, we have no choice.
yeah. Well, I mean, I agree. I think the Fed is doing what they're supposed to do. They get 100 out of 100. You get 100 out of 100 from me, from all the comments and everybody here. How can folks get in touch with you or learn more about your company? Or is this slide available on that website your team shared with me?
We require that people that want, obviously you watched maybe about 10% of this presentation. If you'd like it, send me an email. My email is Neal, Neal, at multifamilyu.com. So Neal, Neal, at multifamilyU.com. And if you want to check out our weekly COVID webinars, which are deep dives into one specific area each week, then just go to multifamilyU.com and sign up. There's always a town hall going. You need to be in our email list to get invites, because we don't always put them on the website. We've been doing so many that not all of them are on the website. But go to multifamilyU.com, sign up for anything there, and you'll be in our email list. And if you want this deck, send me an email at Neal, Neal, at multifamilyU.com. I'll be happy to send the deck over to you.
Okay, great. Well, thank you everybody for joining. I hope you find this valuable and helpful. Kind of different. I mean, I have a lot of different scenarios I'm playing around in my head where it's the sort of the doomsday scenario or the V-shaped recovery. So again, I'm always kind of looking for data or for the signals to cut through the noise to actually try to decide where things are going to go. Stay safe out there. Wash your hands. I probably touched my face a whole bunch of times on this call, but who cares? And we'll see how the whole shelter in place thing goes. Obviously, if we're not able to meet in person, I'll continue to try to find people that have a lot of experience and wisdom to share with us. That's pretty much it. I did remember to record today, so I'll probably try to post this on YouTube, or maybe if the file size is manageable, I just load it on a secure Dropbox or Google Drive somewhere. So
sounds good. Well, thank you for having me on.
Thank you so much.
Bye, everyone. Stay safe.
For your data and your analysis and being so generous with your time to us small potato investors out here. So
You're most welcome. Bye.
okay. Bye, everybody.